And awesome. Okay. So my name is Manjri Agarwal. I am a career advisor at the Career Center. Thank you all for joining us today. And if you attended yesterday's webinar, we loved having you yesterday as well. So Michael and Daniel join us. And they'll go ahead and introduce themselves, and then Michael will kick us off. And then once Michael's done, then Daniel will go ahead and finish it off as well. For those of you attending, if you have any questions, please feel free to use the Q&A box that's down below or wherever it is on your platform. The panelists can see those questions as well as us. And then from there, they can either answer as they come or they'll answer them at the end as well. So without further ado, I know Michael just shut his video off, but hopefully you are good to go. Awesome. Okay, so then Michael, I'm going to stop my video and then you can go ahead and take it away.
Awesome, for sure. Hey everyone, my name is Mike, and thank you guys for hosting this. I am a junior actually at USC. I work with the USC Credit Union. I'm on the board of directors there, and I have a specialty in finance. I've learned a lot about the finance space throughout my 3 years here. I'm happy to share the information I have. And Daniel?
Thank you, Michael. Hello, everyone. Hope everyone is doing well given these current challenging times. My name is Daniel Fernandez. I'm the Vice President of Community Development for the USC Credit Union. Have spent the last 10 years in commercial lending and finance. The last 5 of which were with the philanthropic nonprofit organization called Opportunity Fund, where I was the director of lending. A lot of our work was focused on policy and advocacy for understanding credit and avoiding predatory lending practices and lenders. And so we'll try to contextualize a little bit of what credit looks like today for a new borrower and what some of the pitfalls are with respect to some of our options. So thank you all.
Awesome, awesome. So let's go ahead and get started. I'm not going to make this a daunting chat. I'm only going to take about 5 to 10 minutes to really talk about some basics that I think is super important being a college student and what you need to know about credit. And then I'll go into a quick Q&A where you guys can ask me questions. So to start, I'll just tell you guys a little bit about my story. So I came into college from a family of 9. Was the first male in my family and first one to go to college. And when I got into USC, we're all happy until we realized I was $10,000 short of my tuition, and we had no idea how to get started. We went to different financial institutions, talked to friends and family, and they all recommended, well, the best thing you can do is go get a loan from, a financial institution. And we went to go do that. I approached the financial institution. They said, hey, your family finances aren't the best, and you don't have any credit, so we can't really help you. And I ended up going to 6 other banks, and they all told me the same thing. And I was in this situation where I couldn't get this financial product that I needed, this loan, because I had no pre-existing credit, but also I couldn't build my credit score because I couldn't get a credit card, a loan, or anything that would help me build my credit. So that was my story. And when I came to college, I realized a lot of students face that same problem. So I started engaging with the USC Credit Union, started conducting case studies. I just realized it's super difficult when you don't have pre-existing factors. So if you're international, come from low income, or just haven't been involved in the credit system beforehand, it's hard to get started. So I'll just be talking about a couple of basics on how you can get started as a student. I'll be talking really basic about what a credit score is, and Daniel will take it away with more of the details on how you can get started, especially with the USC Credit Union. So first, let's talk about how a credit score is broken down. And it's broken down into essentially 5 different assets. You have first the amount that you owe, and this is in debt. So pretty much a credit score is derived from debt payments and your payment history. So that how frequently and how long you've been paying off this debt. This can come from a credit card, loan, or most financial products that you can get from a credit union or a bank. A new credit, the length of your history, and the credit mix, so diversity in products, are the other things that affect your credit, but the main bulk of it is going to be your history and the amount that you owe. Secondly, I believe you should start jumping into pretty much how can you start nurturing these factors. And there's a couple of ways that you can start doing that. If you have no pre-existing credit, the best thing you could do is look into getting a secured credit card. is a credit card where you have a down payment on the credit card, so there's no risk for the bank or for you, and then you use the credit card essentially like a debit card. You can look into non-traditional credit building opportunities. So this is like using your rent, for example, can help build your credit. Subscriptions as well can also help you build your credit. So if you have Netflix, gym memberships, anything like that, you can go to different platforms like growcredit.com, Rental Karma, and stuff alike, and they will help you build your credit within 2 weeks, and you'll see a really good reflection. For example, I reported my rent when I had no credit history in my sophomore year. My score went from absolutely nothing to a 670 in the first 2 weeks, and now I'm sitting above a 700. And that was just from reporting my rent. I have no credit cards, no loans, rather than what I have for a university. But all that was really going into helping me build my credit. And then third of all, and this is probably the best recommendation, is to talk to your local institution. The USC Credit Union has amazing offers to help you build your credit and get started. Like a secure credit card line, just go reach out for help and they'll be able to help you out. So the second part that I want to really talk about is the impacts of your credit score if you don't think about it, or if you just wait until later. And this is what most college students do. A lot of my friends have done the same. I won't give his name away, but actually it's been about a year now. He was graduating around this time. He was excited to leave. He had just gotten his job at Amazon up under the tech team. And when he moved over to Amazon, to the one in the Bay, they actually could not help him. He couldn't get the job because he couldn't find an apartment that would accept him without a credit score. So for most of the people who have an apartment or live off campus, you understand you have to have a guarantor. It's harder to get a guarantor when you're moving out of the house and you're trying to separate from your family finances and get your own house. The same goes for a phone plan. Same goes for getting a car. I mean, all the basics that you really need to start living on your own, you got to have a credit score for. So I think the best time to start is now, and to get engaged and start building your credit right away. And that's a lot of the basics. If you have any questions for me, I'm happy to just have a Q&A session where we can just talk about, the different factors. I already see there's a couple questions and we'll just do it that way. So where can you go to report your rent? Yeah. There's a couple of platforms. There is rentalkarma.com. There's this one platform called eSusu Rent, ESUSU Rent. It's an app that will also allow you to report your rent. There's a whole bunch of platforms. Some of them are free. Some of them you do have to pay for. I'm also building a platform myself with USC that allows you to report your rent as well. And it's completely free. So if you're interested in that, you can message me directly in the chat, and we can talk more about reporting your rent to build your credit. Any other questions?
Yeah, so there's a couple questions in the Q&A box as well. So one of them is, what are the two platforms called that you just named that help you build your credit?
Yeah, so like I said, there's Grow Credit. So Grow Credit is going to allow you to report your subscriptions, so Netflix, Hulu, Amazon, and that's free to use, growcredit.com. And then you have, like I said, just now, Rental Karma and eSusu Rent. If you just type in rent reporting into your Google search, you'll find the platforms that allow you to do that.
Awesome, thank you. So let's see. Another question is, and Michael, you can answer this, and I think Daniel can answer this as well. What are the pros and cons of having multiple credit cards?
Yeah, so it's, like I said, one of the factors in affecting your credit score is diversity of product. So a lot of people who are actively building their credit and have a manage on their finances do have multiple credit card lines with different banks and institutions. What you want to do is, it doesn't really matter about the number of credit cards, it matters about your utilization rates. So making sure that you're not using more than 15% per card if you do have multiple cards per month, and paying that off fully every month is the best way to start building your credit. Going anywhere above 75% of your utilization rate will actually damage your score, because it seems like you don't have the funds to actually pay for the credit card because you're using it, all the time. So try to keep it at best 15%. If you have to use it, 15 to 75 is fine. Just don't go over 75.
Awesome, thank you. Another question is, can you elaborate more on what credit is, why it's so important, and just a little bit more if any insights that you have.
Yeah, so overall, your credit score is going to be what your employers, people who are giving you big purchases like a house or a car, phone plan, use to determine your worthiness or your loyalty or ability to pay back for that purchase. So for example, when you go to get your first job, your employers will do a credit check to see, okay, if you have a good score, that means that, you know, you're a good candidate. If you have a bad score, there may be something's wrong with your application. So it's kind of like a universal way of saying, this is my standing as a person, and this is how much you can trust me with financial products, jobs, you know, cars, anything that is, you know, a big factor in your life.
Thank you. So we had a follow-up question on a credit score. So what is considered a good credit score and what is considered a bad score?
Yeah, so unfortunately, the average for a college student is a 500. And the reason for that is because when you leave college, the first thing that normally affects your credit score, if you don't build it, is going to be your loans. And this is very problematic because when you get your loans, you probably have about $30,000 to $70,000 in debt, and they're going to recommend you pay the minimum. And that's going to damage your score because not only is the interest calculated on top of that as well, it's going to take you about 20 to 30 years to actually pay off your debt, unless you refinance it. So you want to make sure that when you are building your credit, you're doing it early before your loan payments come in, because that will start bringing down your score. And the average is a 500. So looking at the scale though, a good credit score, I would say, is anything above a 700. You'll get better rates on credit cards, loans, everything, refinancing. Above a 700 is the way to go. Average credit score is going to be around a 600 to a 650. I'd say the middle range where you're doing okay and you're starting to build your credit is a 650 to a 700.
Awesome. Thank you. So you mentioned talking about percentage of credit usage. Someone asked a clarifying question. When you say 15%, you mean 15% of what?
Of a credit card. So when getting a credit card and using a credit card, you're going to want to use 15% on average and pay that off month over month.
And you mean based on the credit limit, correct?
Yeah, exactly. Based on the credit limit. So if you have like a $500 credit limit, can't do the math right now, but you want to use about $50 to $60 of that credit limit a month. It's okay to surpass that. That's just like the magic number for building your credit super quickly. But just don't go over 75%.
Awesome. And we had a question about the credit union. So again, Daniel, feel free to chime in as well. But as someone that, you know, works in a credit union, has ties to a credit union, do you feel like it's helped? How do you feel it's helped in your personal finance and budgeting?
Yeah, definitely. So Daniel would be better to answer this question. I'm on the board of directors, so I oversee the entire credit union alongside 6 other members. So we're more on the operational side, but Daniel, feel free to chime in right here.
Yeah, we'll definitely cover it a little bit deeper in my presentation. But overall, I mean, the membership requirements and kind of the cohesiveness of the strategy that a credit union has lends itself to being a bit more forgiving with some of the credit requirements. And so it's much more a partner, if you will, an ally in building out some of those initial credit files and history rather for yourself. And as you kind of go through your financial journey, a credit union is a good ally in that it kind of incubates you to be ready for the next step.
Awesome. Thank you, Daniel. Another question was, how do you check your credit score for free? I've heard that sometimes it costs, so that deters me to check credit scores.
Yeah, so there's a couple of myths around credit scores when it comes to checking it. Platforms like Credit Karma, Credit Sesame, NerdWallet are completely free to check your credit, and they won't damage your score. So the myth is 1, it costs, and 2, the other one is going to be that it hurts your score. Checking your credit score will not hurt your score. You can also go directly to the credit bureaus and you get a free credit report from them 3 times a year, I believe. It's like either 3 or twice. But I recommend just using a platform like Credit Karma. It's a really good place to see where your loans are, your credit score, what you owe on credit cards, any debt that you have. It's a really good place to go.
Awesome. Thank you. Let me just kind of go through them as well. There's a lot of questions, so I love it. Just a clarifying question, is credit linked to our social security numbers?
Yes. So your credit score is linked to a social security. If you are international, you would want to, and I know a lot of people who are international, the best way to get a social is to get a job inside the US. So even if it's like a part-time job or a quick job, that you work at just for a little bit, it will give you a social and that will allow you to start accessing your credit line. I mean, not your credit line, your credit history. I'm not sure there is current regulations around an I-10 being operating as, a way to get into your credit line. That's more so a question for Daniel. He'll know more. But yeah, you're going to want a social security.
Awesome, thank you. Another question is, what happens if you don't use a credit card often? For example, if it has gone unused for years, but you are using a different card, should the unused card be closed?
No, actually, you should keep the card because it goes into that one category that I said was really big, and that's on the length of your history of different credit lines. So even if you're not using a credit card, just put it to the side. You can even rip up the card, just keep the account open because it's going to show that you had this credit history line for a long time and it wasn't utilized, which is actually a good thing. If you can use it and put like micro expenses like your subscriptions on it, just like hitting that 15%, that's awesome. Just pay it back, automatically month over month. But if you're not using it, don't close the account. It's better to keep it open.
Thank you. And reiterating, how that was a component of your credit score, can you real quickly go over what the main components of how the credit score is broken down again?
Yeah, so I can give the actual percentages as well. So 30% of your score is going to be the amount of debt that you owe. 35% is going to be your payment history. 10% is going to be new credit lines, so getting a new credit card or a new loan. 15% is going to be the length of your history. So that's going to be having that credit card that you don't want to close, keeping it open for as long as possible. Then the last 10% is a mix. So diversity in products amongst different, lines of credit. So like loans versus credit cards versus, different expenses.
Awesome, thank you. So I'll highlight one last question and then we'll go into Daniel's. So someone asked about credit inquiries. So that could be, I'm assuming, a hard inquiry. So do you advise keeping inquiries low? For example, no more than one credit card every 6 months. So can you just talk a little bit more about the hard credit inquiries?
Yeah, so for everyone who doesn't know what a hard pull is, you have, two different inquiries. You have a hard pull and a soft pull. A soft pull is checking your credit score. So this is going to be done by like phone companies. This is going to be done when you check your, your score on Credit Karma, NerdWallet, Credit Sesame. Quick pulls just to see, your credit worthiness. And hard pull is going to be for big expenses. So when you are opening up a new credit card, when you're trying to get a loan, when you are looking into getting a car, or sometimes even when you're trying to rent an apartment, they'll do a hard pull. Another hard pull is also done by employers. So if you're going on like a job rave and you're trying to apply for 7 different places, you may have 7 different hard pulls on your credit score. Hard pulls definitely hurt your score by a lot. You're going to want to limit that to 1 or 2 a year, or if you can, 1 to 2 every 6 months. I know during, when you're trying to get employment, you may be doing multiple pulls. But doing soft pulls, you can do those literally every day and you're fine. So try to limit it. I would say 1 to 2 every year, if not every 6 months. But soft pulls, you can do them whenever.
Awesome. Sorry, the phone is ringing in the back. But at this point, we will transition into Daniel and his presentation. Since the Q&A is still available, Michael, if you want to type out the answers, that'd be great too.
Yeah, I'll spend some time responding to everybody in the Q&A separately. And I'll also, Lauren, I will write out the credit limit lines. I mean, the credit impacts for you as well. Thank you, guys.
Alrighty, Daniel, go ahead.
Trying my best here. Can everyone see my screen?
It's showing up for me, so I think you're good.
Great, and my audio's on.
Yep.
All right, 1 second. I'll turn my camera back on. 1 second, I think I'm gonna have to stop sharing. Sorry, guys. Okay, full disclosure, I killed my background and I put on a hat because I usually have like a no tie rule, and in that I kind of work for like a financial institution. So I try to be the cool guy in most cases. So this is me implementing my no tie rule and wearing a hat and killing my background. So I'll go into presentation today that is more so focused around navigating what credit looks like. So just to confirm one more time that you can indeed see my screen.
Yes.
Great. So I played with the idea of calling this, not credit 101, because this is going to go over some of the things that that Michael highlighted, but more about what the credit world looks like today as opposed to 5-10 years ago. The credit landscape that exists in today's financial sector is a lot different than the ones that our parents or their parents oftentimes give us advice about, with the influx of non-traditional lending institutions, as well as the online lending world. So I'll try to go over a little bit of all of that, and we'll open a dialogue to answer as many questions as come through. So briefly, to go over just the credit union at a high level. The credit union was founded in 1973. We are what's called a CDFI, which is a community development financial institution as of 2018, which basically means that the funds that we deploy for our members are intended to make community impact. So whether that's in low-income communities or building credit, it kind of speaks to that earlier point of incubating, folks to be ready for the next step of their financial life. We do have a $460 million loan balance, which means we are deploying a significant amount of capital into our USC community. And we do so in a very responsible fashion. We feel like when we incubate folks, we get them ready to take that next step, but also handle the amount of debt that they're taking on, which speaks to that performance number of 99.68. That means almost 100% of the folks that take out loans with us pay their loans, either through our programs or our outreach or the loan structure. We are very healthy with respect to the way that we deploy our loan capital. We're a growing institution of 75,000 members, rather, and a total of $580 million in assets as an institution. That would put us at about a mid-tier level credit union when thinking about the total size of our organization. Michael touched on this. Here's a visual representation of what a credit score looks like, right? And so you heard him mention that 30% amount. Oh, this is basically what your score is calculated on. So you look at the 30% is attributed to the amount that you owe. 10% is the amount of new credit that you have available to you. 15% is the length of credit history, and 10% is the total credit mix that you have. So you heard Michael mention diversifying the type of credit that you have. This is loans versus credit cards versus student loans and mortgages and all the different types of credit facilities. You'll want to definitely prepare yourself to explore diversification. And then your payment history is the largest subset of this graph, in that the better that you pay, the amount allotted to you will positively affect your score. So traditional credit options. Thinking about where to go for credit, right? Oftentimes it's, I remember being, a young child and going to open up my first savings account at my parents' bank. And as I started to toe the line with respect to building credit, it was at a financial institution. Some of the fundamental differences between a credit union and a traditional bank or a larger bank institution are in just the management structures. So, a bank is, a for-profit institution that has external shareholders, and they're beholden to making the most amount of money for those folks. So not villainous or bad by any means, but it dictates the way that they distribute their funds and deploy their products, because profit is the #1 measure of success for that type of institution, which oftentimes means that there's, you know, higher rates on loans and lower rates on deposits, but only in comparison to that of a credit union. And so I try my hardest, full disclosure, to not, you know, sell our program, our product, or our institution. But these are, you know, pretty cut and dry, point blank facts in that credit unions are not for profit, and there's no external shareholders. We're beholden to our members, which oftentimes leads to the fact that we offer lower rates on loans and higher rates in deposits, because it does lend itself to a larger strategy of being for community benefit and helping folks get ahead, and again, kind of incubate individuals to be able to take advantage of some of the larger sector financial products that are available to the folks enrolled in our programs. So fintech lending is exploding. So the first two items that I outlined were credit unions versus banks. Kind of the elephant in the room as of, you know, 2015 and growing is the financial tech sector. We've all seen, you know, the lending forms for places like Lending Club or the commercials for Rocket Mortgage, and they all skew towards taking traditional lending products online with an added convenience and with kind of a lower emphasis on credit worthiness and documentation. And so this is a representation through 2018 of the growth of those financial tech models in comparison to traditional kind of hard money lenders, credit unions, and banks. And so while you can kind of draw a direct correlation that overall lending activity is declining in those other sectors while increasing within financial tech because of the convenience factor. I'll pause in that I noticed there's a few questions. If Manjari, you'd be so kind as to feed me a couple of those. I'm out of space on my screen.
Yeah, no, you're totally fine. So one of the questions is, can you open a credit card with the bank, use it, but not open a checking account with the same bank? Is this typically done?
Yeah, so banks are impartial to relationship. So if you're going to your local Wells Fargo, Bank of America, a lot of times it wouldn't be crazy to say that most people start their financial institution relationship with a credit facility, much like a credit card. If you were gonna make that same endeavor with a credit union, membership is required, and you would be required to open a depository account with a credit union.
Awesome. So another question is, do secured credit cards require any credit score, or do they count as a hard pull inquiry?
So they do not require a credit score, in that, as Michael mentioned, a lot of that risk is mitigated through the fact that you're allotting a certain amount for deposits. So you put $500 down on the card, your credit allotment is $500. So it's intended to be kind of that first step for an individual to build credit.
Awesome. And then we have another question about the benefits of joining the credit union. So what are the benefits of joining the USC Credit Union for someone who's already a member of another credit union?
Yeah, I think our CEO would back this, and Michael knows him well, is that if you've towed the line to become a member of a credit union, one of the overarching themes of credit unions is people helping people. So I think that as a movement, you've satisfied most of the folks that believe in the credit union model. As a student or faculty, staff, or alumni of UFC, there are unique opportunities with respect to pricing with the USC Credit Union, because even in the credit union space, we're priced probably more aggressively than most financial institutions within the same space. So as you think of your larger financial picture, if you think about the times when you're going to start to purchase maybe a vehicle or a house, I would venture to say, as a newer member of this particular credit union, that from a pricing standpoint, it's probably one of the best options that I've seen with respect to overall charges on those items, which are typically big ticket. I'm going to pause questions for a second, and I'm going to move through a couple more slides because I'm thinking the next few will evoke a few more discussion points. If
Awesome.
That's okay. Fantastic. Yep. So as a new borrower, as someone who's new to credit overall, there's as an underwriter, as a community dollar deployment agency, these are the kind of three buckets that institutions create their underwriting criteria for lending. And so when we're analyzing your credit, we're trying to figure out what is a borrower looking for. And so some of those considerations for a new borrower are what matters most by importance. And so listed in order of priority, A, will I qualify for the loan? Is it easy to get this loan? Can I get the money when I need it? And for some, and a growing faction of folks that are entering this pool, can I afford it? And can I trust the lender? As you look at the profile of the individuals who make this subset, we're getting to a point to where folks are starting to prioritize speed and ease over cost. Both banks and credit unions are often criticized for having favorable rates, but the cost of doing business is oftentimes a burden with respect to the documentation that's required or the time that's needed to process an application. So the growth of financial tech and some of these alternative lenders really emphasize you can do less with more, and you provide less documentation and won't weigh so heavily on your credit score, and really appeal to this type of individual and this growing profile. Limited money management skills, right? I don't want this huge, cumbersome, complex promissory note where I have to understand finance at a granular level. Who can simplify this for me? And so that's being taken into consideration by a lot of the lending folks that are entering the space. And underbanked and unbanked.
Oh no, Daniel, you froze. Let's see. Sorry about that, everyone. One of the downfalls of technology when there's technical difficulties. All right, so it looks like Daniel will sign back in, but keep the questions coming. Michael is doing a great job answering them. And on the back end, one of the things that I am also going to be able to do is pull the Q&A report and be able to filter through the questions that have already been answered and the questions that you all have asked. And I will send that out in addition to the recording and the slides from Daniel's presentation. All right, so it looks like Daniel's back on.
Sorry, folks. Sometimes the camera share slide combo is hard on my internet. Let me see if I can share my screen one more time. Let me know if I'm live.
Yep, you're good to go.
Fantastic. I think the last point I was making was around the underbanked and unbanked. So there's two kind of determining factors for early entry credit facilities, and therefore folks that are new to credit, and then folks that are credit challenged. And so you'll find in the coming slides that a lot of the strategies for financial institutions are geared towards folks that are entering the space or looking to rebuild their credit. So it's establish and reestablish credit on a credit facility standpoint. And the consumer behaviors. This assumes that some of those folks are starting their credit, and so that there's no or thin file FICO history, meaning that they're going to skew towards a product like a secured card or a rebuild or credit builder type of credit deployment product. Often used the department store cards for intro credit. I know, like, one of my first credit cards was a Macy's card, and they are good for entry level credit building, but oftentimes can lead to debt cycles, as if you're not managing that appropriately. They're some of the largest line items for delinquency that underwriters see on loan profiles. And then an increasing interest in alternative financial service providers. So I'll go in the coming slides to outlining what some of that looks like and what the lending landscape is for alternative products. But you'll find that you might be more familiar with some of them than you think you are. And before I go on, I'll pause and if there's any more questions.
Yeah, awesome. So someone asked about opening up a savings account during these economic times. So I don't know how much you can speak to just the economic situation right now, but the question was, is it smart to open a savings account with the credit union during these economical times? Are there benefits right now? Will you see profits?
Yeah. So every financial institution across the board was bracing for some type of economic recession. We had anticipated within the next 18 to 24 months, there was going to be some type of dip, whether it was the housing market or overall economy. Those things were being taken into account. I would be hard pressed to tell anyone to not invest in themselves. A savings account at any point, if you have the ability, is always, I think, a safe bet. There are a myriad of statistics that exist around folks that have, a lack of emergency funds for, a rainy day or an emergency. If the COVID-19 epidemic, provides proof points for anything, it's that having a rainy day fund, planning for the future, planning for the unknown financially is definitely a good thing to do. The return rates on any type of interest-bearing savings account are decreasing across the board at any institution that you look at. I will say at the credit union, they're higher than most, but in all honesty, and to be perfectly candid, that it's marginal. It's making a decision to meaningfully invest into a savings account is just that. It's an investment into yourself for a rainy day. Anything else?
Yeah, so another question was, if you had something in collections and saw it decrease your credit, how would you increase your credit fast once you pay it off? Would your credit increase once you pay collections? Does it come off your credit report once you pay it? Just a little bit more about collections and how that impacts your credit.
Yeah, so there's a certain level of ambiguity with respect to underwriting, and what you're trying to determine for an approval in any case is the character of a borrower, right? One thing that's not listed here are the 5 C's of credit, and one of those C's is the character. And so while you want to avoid at all costs getting to collections, if you indeed enter the point of where you're dealing with a collection agency, it's in your best interest to either pay off as quickly as possible or negotiate a payment plan of some sort. Because what you're saying is to a potential lender is, I've had a hiccup, but I'm doing my best to address it, right? And I'm not irresponsible with debt, and you can trust me to an extent to make good on any lending facility that you send my way. It's a gesture of good faith, but it's one that, in the grand scheme of things, bodes well when looking to secure more credit. And so I would land on, it's always best to either negotiate or be able to articulate what your payment strategy is for anything that's gone into collection.
Great, thank you.
Yeah.
So just a quick question. Are there financial advisors at the credit union? Is that a resource for students?
Yeah, I mean, not a financial advisor in the sense that, someone's going to help you out with investments. The credit union doesn't necessarily focus on those types of products and programs. But any banker that you spoke to, member services representative, is well versed in all of on all things credit and all things savings, and really could serve as a guide to whatever your goals are. I would recommend that if you had general questions or an idea of what you were looking to accomplish with respect to your finances, a conversation with a member service representative is always encouraged.
Awesome, thank you. So
yeah,
we do have a couple more questions. Do you want to keep going, or do you want to?
Yeah, we'll breeze through these next few, and then we'll open it back up.
Awesome.
So just a quick visual on what community lending looks like today. So these are going to skew towards new borrowers and credit challenged individuals for one reason or another. Either they've entered into collections or they're relatively new. And so these are a lot of the places that you'll see that if you ever fill out like one of those win money now type of marketing strategies at like a basketball game or something like that. These are the companies that are paying for those, that are paying for your data, that want to essentially market to you. And so in the online sector, it's places like Lending Club, Upstart, and One Main Financial. And you can see that, these move relatively quickly. The approval amounts are, 1 to 3 days. You can get anywhere from $1,000 to $50,000. And they move relatively quickly. It's a high volume of applications and processing. And you can see that the minimum FICOs are relatively lower than what would be expected from a traditional institution. So you can see FICOs as low as 580 to 620. And these are all unsecured rather. They don't require any type of collateral or that initial down payment investment that would be required on, say, a secured card. Pricing is where they make up for this across the board on all the products that we're going to share on this slide, is that for that added convenience, for that foray into a larger amount of risk, you'll see interest rates as high as 35, 36%, with a shorter amount to pay back, with terms limited to roughly around 15 months. So I mean, these are soft hit pre-approvals, and you might be familiar with. Had you ever filled out something like that or been marketed to from an institution like this, you'll often hear marketing taglines along the lines of "you're pre-approved for $50,000" or "refinance that $10,000 that you have outstanding." And I guess the buyer beware word of caution for myself would be that though it may be easy, it may come fast, it does definitely come at a cost on the unsecured front. As you enter auto, the general themes are the same in that funding amounts are quick and fast, but limited in the auto space. Usually only go up to about $30,000. And some of the key companies there are places like Westlake Financial, Open Road, and Credit Acceptance. These places actually offer credit facilities for a car without a FICO. And so say this was like your first credit transaction, you can definitely get access to capital to get a car at a significant cost. I mean, you're looking at 24% APR. Sometimes terms are extended between 72 and 84 months, but there's also loan fees associated with that aren't amortized in that first amount of 24.99%, which could oftentimes take that number through the roof. These are companies that bill themselves as credit builders. I would say that as you explore these type of options, when you're looking for an institution or a lender to purchase a car, if not with our credit union, credit unions have made their name on auto lending and home lending. And so these are usually key places to go to get a similar level of leniency with respect to credit at a fraction of the cost. I feel like anything in excess of 7.5% for an auto loan is egregious. So just something to consider. And some of the other short-term and longer-term installment loans, in and around the USC community, there's a USC Credit Union, there's a Bank of America, and maybe one or two other financial institutions. What you will notice as you're driving up and down Figueroa is there is a bunch of title loan companies or cash advance payday type lenders. These are some of the most aggressively priced type of institutions in that they offer instant 24-hour funding, minimum FICO requirements, and are usually secured by some type of employment that you have. These are not loans, though are oftentimes billed as get out of a bind type solutions. Will not do anything to aid you in your credit building. So these are not reported to your FICO score, are not recorded in any of the credit impact holders to be able to determine your ability to pay for future endeavors. And then some of your long-term installments are similar to the short-term in that they are companies like Opportune, amounts that are limited to 10,000, quick capital, that are focused on keeping you kind of on the hook and getting you to reapply for loans that you may or may not be able to pay for. There's not a whole lot of documentation and underwriting required on these type of loans. So they do sometimes create a more of a burden than I think the intended purpose of helping folks build credit. Going to the next slide very quickly, just a visual representation of what the last slide is. You can see that FICO averages anywhere from 0 to prime, which is considered 700 and above for some of those companies that were outlined. I think the thing that I would take from this slide is those APR, those annual percentage rates. 120%, oftentimes in excess of that is again egregious. And so that the trade-off for convenience and speed is price. So just as a new borrower, as someone who's towing in line with credit, just do your due diligence. Know that if you're going online, if you're going to one of these alternative lenders, know what the benefit is for yourself. Know what the shortfalls are. And if you are looking to establish or reestablish credit, that there may be better options for you. And so in closing, I think I just wanted to show, not in closing, penultimate closing, is take a product and show what it would look like across the 3 channels that we've discussed today. What an alternative perspective would look like, what a traditional bank lender would do with a similar loan, and then us at the credit union how we would treat that same loan request. And so we've used an advanced loan for comparison on this slide, and this takes in to account a payday loan. And you can see at a conventional payday type of lender, you'll see that the advertised term is usually up to 2 weeks, and it comes in a lump sum. It's an amount loan up to $500, and the price will sound doesn't sound too bad in that it's $15 for every $100. If you were to amortize that and get the APR, that's 391% on that $500. And so the monthly payment oftentimes is about $150 and only includes the fees and assumes that you're going to roll over that amount time over time. The bank equivalent of that product is similarly termed out 2 weeks, will also go up to $500, and it's $10 for every $100. Significantly lower in that it's 261%, but mind you, it's still 261%, where the average rates for these amounts in community lending for micro lenders is oftentimes 25% and below. And so the $100 there would include fees and oftentimes comes directly out of an ACH account that you have with that bank because it assumes some type of relationship there. That same scenario at a credit union, not even saying the USC Credit Union, but this is a kind of a token product at all credit unions for financial advancement and empowerment. As opposed to 2 weeks, we oftentimes term these out to 6 months. And the amount can be as low as $100 and as high as $500. That 18% interest is fixed and is supplemented by a $10 to $20 application fee. This can come out of an ACH, but you'll oftentimes have a monthly payment that is never in excess of $50. There's a requirement that you be a USC Credit Union member, but again, I think speaking about the relationship with any credit union, there are added benefits to starting that relationship early and building kind of your financial future with an ally and a partner that is able to look fondly upon your credit history. I'm seeing my screen light up with questions, so I'll open it up before entering the last slide.
Yeah, so a question that was earlier was about student loans that your parents co-sign on. So the question is, do student loans that your parents co-sign on hurt both of your credit scores?
Anyone who signs on onto a loan is what's known as a guarantor, and essentially saying with their signature that if the individual A doesn't pay for whatever reason, I, individual B, am accountable for that debt. And so yes, both credit profiles would be impacted by an inability to pay.
Thank you. Another question is it free to transfer money from an outside bank to the USC Credit Union savings account? And does making many transfers affect our credit score?
So there's no effect on your credit score for transferring money. Don't quote me, as I'm not a product expert, but I believe there's a certain amount of transactions that can take place fee-free. So typically it's 5 transactions from an outside institution to a savings account can happen without any fees, and then you can incur fees if you're in excess of the allotted fee structure.
Awesome. So let me look. So another question is, can you talk a little bit about credit cleanup? So old debt, charge-offs, are those credit cleanup companies legit, and are they necessary, or can USC help with that?
Yeah. So huge market is the reestablishing credit cleanup company. I think one of the worst things you can do as an underwriter is take advantage of anyone who says they can remove items from your credit report. There's flags for that. in the credit system that we use as underwriters that will show that someone has gone through that process. And so while it may boost your score, it comes with a notation that your credit has been scrubbed, if you will. I would say, work as best as you can to come to an agreement, pay off what you can. I wouldn't necessarily recommend engaging, a credit cleanup facility to clear anything that's delinquent unless it was fraudulent, because it does provide a notation for the institution looking at it that could negatively impact your application.
Awesome. And then another question that is more about resources. I know you mentioned, with credit union, there's not necessarily financial advisors, but someone had a question about what are some resources available to students with regards to learning about investments and stocks?
Yeah, so while we don't house any in the credit union, we do have partnerships with 2 financial education institutions, one of which is EverFi and the other is GreenPath. Both are kind of like credit counselors and financial coaches, and so kind of work with you on a more one-on-one basis to develop plans and kind of answer what your questions are, and develop kind of strategies to either offset or supplement, whether it's savings or investments or purchases. They're able to get a bit more granular than we can in the credit union branches.
Awesome. And I just also wanted to add, in addition to that, the Career Center is working with a vendor called Real World Playbook, and that's on our website. And they have really good informational videos about the basics of things, but also they have some about investing in stocks too. So that's available to students and alumni as well. So feel free to check out our website for that as well. But awesome.
Yeah.
There are a couple of very direct questions left, but Daniel, I feel like, if you wanted to kind of close it out, that'd be great.
Yeah, I know we're coming to the end of our time together, so I'll get through our last slide here and open it back up. So, warning signs and I guess just things in general as you guys enter this space and again navigate what credit looks like is by all means you'd want to be aware of and avoid any type of lender that tells you or asks you to falsify information with respect to income. That takes your initial inquiry and is trying to talk you into a larger amount in general, but oftentimes, a larger amount than you can afford. A fail to disclose loan terms in any respect should definitely be a trigger. As you have very direct questions, they should be able to provide very direct answers. And so in any scenario where you're being asked to sign blank forms or won't give you copies of your documents, you should know that you're dealing with an unscrupulous type of lender, and really start to assess your options. In the event it seems too good to be true, the old adage is that it probably is, right? Costs. I think if you ask nothing else and you landed in a place of just trying to determine what this is going to cost you over a certain amount of time, a lender should be able to provide some type of promissory note, calculation, payment assessment, should be able to tell you with a certain amount of certainty what you should expect to pay overall. These is kind of like call outs, token beacons as you enter the credit space and have questions for your institutions would be good things to notate and rules to live by.
Awesome. Alrighty. So another question that we have is, I've heard that a credit card is kind of like a loan, but also loans damage our credit scores. However, credit cards can also improve it. So can you just kind of explain a little bit more about why that happens and kind of what the relationship is?
Yeah. So Michael touched on overall usage, and the largest part outside of payment history is the types of credit products that you have available to you. So a credit card is in theory intended to be used on a monthly basis and paid off on a monthly basis. So running a balance on that does have an impact differently than, say, like an installment loan, which is expected to be paid over time. So understanding, usage of funds is probably, a more appropriate deployment strategy for credit. So knowing that any long-term purchase should take place on a loan, and any short-term, I believe Michael called them, micro purchases, would be better placed on a credit card, something that you can, charge and hope and plan to pay off in the coming 30 days.
Awesome. So another question we had was about the Parent Plus loan. So someone mentioned that their mom took out a Parent Plus loan, but they themselves are the ones making payments, building the mom's credit. So is it possible to make the payment count towards the individual's credit as well?
I mean, in that particular situation where the guarantor, the person that signed, is the mother, that's who's going to reap the benefits. There are scenarios where you can be added as an authorized user, and so any activity that happens on that credit product will affect anyone who's listed as an authorized user. So for instance, if you had like a Discover card in your mom's name, but she asked to have you added as an authorized user, every positive payment that she made would reflect on your credit profile in a minimized aspect. You'll show as an authorized user, so you won't necessarily get full credit for it, but it will show that you have positive payment history for the amount on that particular credit facility.
Awesome. And then the last question I wanted to touch upon, Michael answered this in the Q&A a little bit earlier, but people ask questions about like department, like retail credit cards, store credit cards, and things like that. So what are your thoughts on, those types of credit cards, and how do you think they compare to other like bank credit cards?
From an overall cost standpoint, I mean, any bank, credit union, I'll even venture to say some of your online banks, places like Ally, are, from a pricing standpoint, going to be more advantageous for you. They may be a little bit more difficult to secure in that the criteria sometimes will require that you kind of have a stepping stone, a step up approach, and that you start with like a secured card and graduate to something like that. Department store cards are typically seen as the barrier to entry and the easiest way to enter a credit product, in that the amounts are typically $500 or less and can grow over time, and there's not there's not as stringent of credit requirements to get approved for something like that. So you really have to ask yourself, I mean, what's your end goal? Do you have the ability and the time to invest into something like a secured card and graduate to an unsecured credit product with your financial institution? Or does a department store card serve a purpose for you, something that maybe you do shop there often and you are comfortable with your ability to pay it off? It could be seen as a fast track to growing your credit profile at minimal cost if you're able to pay it off on a monthly basis.
Awesome. Well, thank you. I want to be mindful of everyone's time. So I know we were a little over, but we appreciate you speaking a little bit more, and just in general, both having you, Daniel and Michael, for today's session. So I will leave it at that. And with that, Michael and Daniel, if you have any last words, I can defer to you all. But for those of you attending, again, I will be gathering the recording, the Q&A that was answered, and just any last minute slide presentations, and I will be sending that out hopefully by the end of this week, and if not, then early next week. But yeah.
Thank you to everyone. I really appreciate the opportunity to speak with you all. In the follow-up communication, my information will be available. If there's any additional questions, I'd be more than happy to speak with anyone who is open to it. So thank you.
Thank you, Daniel.
Yeah, thank you guys for this opportunity. It was super cool to talk about finance like always. And thank you, Daniel, for your time as well. I realized a lot of the questions ended up being about rent reporting and subscriptions. So if you are interested, I plugged the website in there multiple times. but hatch.credit and growcredit.com are two awesome resources for that if you're looking for those.
Awesome. Alrighty, well, thank you everyone for joining. I will stop the recording now, and we have our last session tomorrow. So have a great rest of your day, everybody.
Thank you.